Hi, we are from Unita Kuching. My name is Nur Iza Adira.
My name is Nurdayana Isni.
And we are choosing topic 1, Introduction to Accounting and Principles for our assignment 1.
And then we are going to explain the whole topic in the next video. I'm going to explain from introduction to the types of businesses.
And I am going to explain the topic private and public company until the end of the explanation.
Hi, my name is Nurdayana Isni and I will explain about Introduction to Accounting. What is accounting? Account is known as the language of business and it provides pertinent information helpful in making economic decisions. Accounting involves the process of identifying, recording, and communicating information about an economic entity, which can be used to make informed judgment and decision. Economic decision result in provision of resources such as money, machinery, land, and labor that a business entity used to provide goods and services. And accounting involves the process of identifying, recording, and communicating. It also can be used to make informed judgment and decision. The transactions are recorded in books of original entity, and then the transactions are analyzed and posted to the ledger. Finally, their transactions are summarized in financial statement. The history of accounting. Accounting began because people needed to record their business transactions, know if they were being financially successful, and know how much they own and how much they owe. The next slide is accounting concept and assumption. The first one is business entity concept. This assumption requires that the activities of the entity be kept separate and distinct from the activities of its owner and all other economic activities. For example, when owner of the business uses the business check to buy a tablet for personal use, this transaction will be not part of the business asset because personal can't mix with business. The second one is going concern. This assumption considers that the operation of the business entity shall continue in the foreseeable future without being closed or sold. Consistency is the company should use the same accounting policy, method, and estimation technique for the same transaction over a period of time. This is to ensure that user can compare the performance of the company over time. The prudent concept. The prudent principle in accounting is many times described using the phrase do not anticipate profits but provide for all possible losses. The next slide is realization concept explanation. It is a profit regarded as realized only when it is received in cash, or the legal right to the receipt of cash is obtained from a transaction. The profit or revenue is determined by the following principle. The first one is the critical event principle, second is the asset transfer principle, and then the last one is the certainty principle. The critical event principle is the critical part of any business operation is selling goods or services. And then the asset transfer principle is the sale takes place once the seller ceases to be the owner of the goods and the goods become property of the buyer. That is, the ownership of the goods is transferred from the seller to the buyer, while the seller obtains the legal right to claim the money from the buyer. For the last one, the certainty principle. The sale achieved must give the seller legal right to claim the agreed price of the goods sold. Dual aspect concept is based on the entity concept and it's established the accounting equation. It states that every transaction has dual effects or twofold effect on the asset, liabilities, and capital of an entity, but at the same time, the equality of the accounting equation is maintained, such as asset equal to capital plus liability. There are three types of businesses. The first one is sole trader. It is people who work for themselves, and the terms of sole refer to the ownership of the business. For example, include shopkeeper, plumber, hairdresser. And second is partnership. It is two or more people decide to share risks and rewards of a business together. For example, it includes an accountancy, medical or legal practice. The last one is company. A company is a legal entity and it's considered as a separate entity from its owner. For example, if a sole proprietor or partner in a partnership cannot afford to pay the business debt, the asset of the owner or partners may be used to settle the debts.
Next, I am going to explain the difference between private and public company. For private company, the number of shareholders are ranged between 2 to 50 only. Meanwhile, public company, the number of shareholders are ranged from 2 persons to unlimited number of persons. The users of accounting information are divided by two users, which are the internal users and the external users. The internal users are such as owners, managers, and employees. For external users, there are suppliers or creditors, investors, lenders, customers, and government agencies. Moving on, I am going to explain the definition of assets and types of assets. Assets are resources that are owned by a business. And there are two types of assets. The first one is non-current asset and the second one is current asset. Non-current assets are divided by three, which is intangible non-current assets, tangible non-current assets, and investment. Next off, the definition of liabilities and types of liabilities. Liabilities represents what the business owes to outsider. Simply put, it is a debt. There are two types of liabilities. The first one is long-term liabilities and current liabilities. Long-term liabilities are amounts owned by the business that are not repaid within 1 year. For example, long-term loan, mortgage on premises, and debenture. Current liabilities are amounts owing by the business that are to be paid within a year. For example, bank overdrafts, account payable, and short-term loan. Owner's equity are contributions of assets by the owner into the business. Revenues represents the gross increase in owner's equity resulting from business activities entered into for the purpose of earning income. Example of revenues: rent received, sales, commission received, and discount received. Expenses are the cost of assets consumed or services used in the process of earning revenues. Example of expenses are such as wages, insurance, rent expenses, and postage. Next, I am going to explain about capital expenditure and revenue expenditure. Capital expenditure is expenditure that increases the asset's value because of the improvement on the capacity and efficiency. The following expenditure are capital expenditure. The first one is sales taxes for purchase of non-current asset, legal cost, installation cost, and extensions or additions to a building. Meanwhile, revenue expenditure following expenditures are regarded as revenue expenditures. The first one is repainting of office block. Number 2 is replacing a broken window screen. Number 3, motor vehicles fuel. And number 4, motor vehicle insurance.
This is the classification of the following items into current asset, fixed asset, current liabilities, and long-term liabilities.
For example, office machinery, fixtures and fittings, land and buildings, leasehold, premises, and motor vehicles are classified as non-current assets.
Debtors and cash at bank is classified as current asset, and for long-term loan from my bank is long-term liabilities, while creditors and bank overdraft is current liabilities. Classification. We hope you liked the video.
Thank you for watching.